So welcome to the client review workshop for 2018. Just as a reminder, this was created out of a need for wanting to give you that much more value in the review process. So if you remember, our review program is called the Progressive Review Program. We're spending a lot of time wanting to cover the individual investment performance and what we thought was going to happen with the markets ahead, what happened with the markets before, financial planning opportunities, all of those different things were taking longer and longer up in the review meeting. And of course, then there's all the stuff that's specific and unique to you guys that we need to cover in that review meeting too. So it was becoming more and more difficult to get all of that done. And as a result, the client review workshop works really, really well for us, and we're getting amazing feedback from clients as well, because it allows us to spend a bit more time on the stuff that applies to most, if not all of you. And then in the one-to-one meeting, that can be at the time of the year that's right for your specific circumstances. It can focus just purely on the stuff that's unique to you, and it can ensure that we could get the best of both worlds. And of course, it allows us to do it in a timely manner so that we can actually deliver all of these things across all of our client base in a realistic time frame. And that's one of the big problems a lot of financial services firms are having at the moment, is that they're struggling to deliver the service that their clients want and what the regulator expects, I suppose, but haven't innovated as to how they deliver that review service in a way that is realistic and feasible. And that's one of the reasons why we introduced the client review workshop about 18 months ago. So let's dive in now. Hopefully you've all received your review pack. The main document within there is called the review pack, and that's the one that I would like you to ideally have open while we're going through this, because I'm going to walk you through the different pieces of that pack. And just before we do that, I'd just like to remind you that for those of you that completed the pre-review questionnaire, thank you for that. Even if you don't put much detail on there, what it does is it tells us what has or hasn't changed. If you haven't completed that, and I know a couple of people haven't, then it really is valuable to do that for several reasons. One is it keeps us up to date with your ever-evolving situation. It tells us what's changed in the last year. And whilst that might not be seen significant for you, it may allow us to spot an extra opportunity for you to improve your planning further. But finally, it also allows you to tell us what you're thinking about for the future, so that you can tell us about any different what-if scenarios that might be worth modeling for through the lifetime cash flow forecasting. So for example, if you're thinking, I might buy a bigger house, then we can model that in the cash flow forecasting for you in the review pack, so that you can see the impact of that decision on your financial future. So it really is important that you fill that review pack in, and thank you for those. Most people have done that, so thank you for those of you that you have. That's allowed us to tailor the recommendations that we're going to come on to later on for you. So if you go through your review pack, you'll see that the first section is called the Efficient Portfolio Summary, and this is just a slightly expanded version of what we always call the one-page summary. It's sort of drifted onto a couple of different pages, but you'll see that there is a page for any protection and life insurance and all that sort of stuff that we've got for you. On that particular page, there will be an extra column here that shows you the cost of going off and redoing that policy again today. So if you were to rewrite that policy today and it was cheaper, then the number will appear in green, and if it was more expensive, then it will appear in red. If we found a way of redoing your protection for you cheaper than you're currently doing it today, then that will appear in the recommendation section later on. We've then got the investments page, which looks at all of the different investments. Importantly, it also includes the risk score for each of your different investments, value as of last year, current value, total amount invested, and monthly contributions or withdrawals that are being made. Plus, crucially, any ISA allowance that's left available. Then we'll come on to your pension. Again, similar sort of tab, contribution and withdrawals, risk score, last year's value, current value, and then you've got the total portfolio value there. And the idea of these pages is really, you just want the one-page summary of kind of what's going on in each of these areas of your finances. It's worth covering off here that one of the things that we want to review each year is the costs of the underlying platforms. Now, most of our clients use WealthTime as their platform. Not everybody does, though. A few people have Transact or Praemium, where for whatever reason WealthTime wasn't quite right. WealthTime is our preferred solution where we can use it, but it works better for higher value portfolios. So some lower value portfolios we use Praemium for. Either way, with WealthTime and Praemium, we're still really happy with those. From a cost point of view, they are the best cost structured platforms out there, and they give us access to portfolio metrics. So we wouldn't recommend any changes if you're on the WealthTime or the Praemium platform. For Transact, we tend to have to do that where we want to hold direct stocks, or if, for example, you are not resident in the UK or weren't when we set this up for you. So Transact is slightly more expensive. In an ideal world, at some point we'll be looking to move you across to WealthTime or Praemium, but that will depend on the underlying reasons why we had to use somebody like Transact for you in the first place. Either way, though, we have not made any structural changes to the platform panel we tend to work across, because those platforms of WealthTime and Praemium and then Transact, when we need them, have been extremely good, and they're still very cost effective. So then we go on to one final page actually like this in your pack. We'll then just touch on estate planning. I'm going to come back to estate planning later on, but it will just touch on whether we've done wills, trusts, lasting powers of attorney, those things for you as well. The next section of your review pack should be your lifetime cash flow forecasting. So I want to remind you exactly what these charts are telling you. So we've got the first charts will look something like this. This is your income versus expenditure. So each blue block is an income, a load of income for a year right the way through to age 100. We model pretty much everybody to age 100. You may be thinking, well, I probably won't last to 100, but one of the greatest risks to your long-term money is living too long. So it's much better to plan for living to 100 just in case you do. So the blue blocks are your income. The black line is the expenditure we've modeled into the cash flow forecasting for you. And blue is good because it means you've got sufficient income to meet your expenditure. Red is bad because it means that you've got insufficient income to meet your expenditure for those years. So these two are obviously the same type of chart but different situations. This person is on track to run out of money later on. This person is on track to have sufficient income later on. Now, one thing to look at here is firstly, any red should be ringing alarm bells. We need to be saying, okay, fine, what can we do to address that red? You know, maybe put more money into pensions or ISAs to try and eliminate it, maybe retire later or spend less. You also, even if this is all blue, you want to be thinking about, okay, particularly if you're a long way from retirement, what we'll have modeled for you in retirement is basically what you're spending at the moment minus the things that will stop, like mortgage payments, like school fees, those sorts of things. So you may want to look at this in a little bit more detail and say, well, okay, that's great, Charlie, but in this example, we've only modeled 30,000, dropping down to 20,000 a year income in retirement. I know that I really want to have a minimum of 50,000. If that's the case, let us know and we'll build that into your cash flow forecast so that you can see whether you've got enough money to look after you for right the way through to the rest of your life. Second key chart is the liquid assets. So this is what's going on in terms of the value of your investments and pensions throughout your life. So the first one is telling you your income for each year. This is telling you what's going on in the background. Now, these two scenarios are the same. They relate to the first two scenarios. So this is the person that was running out of money. You can see why they're running out of money, because they're basically eroding the value of their investments. Whereas this person, they had more than sufficient income, if you remember, but you can see actually their investments are rising. So what we can take from looking at these types of charts is that this person needs to be saving more, spending less in retirement, retiring later, those sorts of things, whereas this person could actually be spending more in retirement, retiring earlier, or starting to think about inheritance tax planning. So just look at those cash flow forecasts we've done for you to see how your financial planning is currently mapped out. Now, occasionally we all have something like a pension scheme with a different company that we don't know about that isn't modeled into these things. So we've also given you a bit of a breakdown of what's going on with these with your cash flow. So if you see anything that we're missing, then by all means tell us. Now, this doesn't include property. We do build property into your cash flow forecast, but actually it's not that useful for showing you what's going on. So you usually use the liquid assets chart, but the property, it should be built in. And then finally, we'll have built you, excuse me, some what-if scenarios based on anything that we've talked about that we know is still a particular opportunity or concern for you, or anything that you've put in your pre-review questionnaire that we thought, well, okay, let's model exactly what you're talking about here to see what the impact is. So that's a bit about the lifetime cash flow forecast. I don't want to just touch on where the markets have been or been going, and maybe we'll even think about where they're going in the future. Now, each time we send you a quarterly report, hang on, I've got a question. Is the cash flow forecast? Yes, thank you, Andrew. Great question. What we've done is we've eliminated inflation from all of your lifetime cash flow forecast charts. Quite often we'll have done cash flow forecasting charts that include inflation and then also eliminate inflation. But actually the ones where we eliminate inflation are much more useful. So we've just done those we'll just use those going forward because it just keeps the whole thing more simple and more valuable. So thank you for that, Andrew. Great question. So this chart here appears in your quarterly report that we send out, the quarterly investment report that we send out every quarter, funnily enough. And it's just worth looking at each time because what it does is it shows you all the different asset classes that you could be invested in and how they've done over the last year, the year before that, and also the last quarter. Excuse me. And really, you don't need to look at this in great detail, but the point is, if you look at this and everything is up as it is at the moment, then we can safely say that we can expect the portfolio to done fairly well. If we look at this and we see asset classes or all of them being down, then we can expect the portfolio to have done more poorly because the headwind to get good returns has been much, much more difficult. So it's just a good way of managing your expectations before you go on to look at your own individual performance. So we can assume at the moment that the performance should be fairly good because everything has been growing in a positive way. And that's really what we can see when we look at both the World Index and the FTSE 100. They've both grown astonishingly well in the last 12 months. And in fact, you know, the FTSE 100, which has been lagging behind the World Index a little bit over the more recent years, has really done quite well compared to the world this last year. This is the last 20 years, so you can see that gap has been opening up between the UK and the World Index over that last 20 years. But actually, in the last year, it's kept pace with it very well. The important thing really is, though, because of course you're not investing in just the World Index or just the FTSE 100, you're investing in a diversified portfolio that includes stocks, bonds, property if you invest at a certain level of risk and above. And so actually the key to a diversified portfolio, as I've always said, and I've probably said it to you all in person one time or another, is that the benefit of a diversified portfolio is that you're trying to hang on to the coattails of the market when it's doing well, but protect in the downside. And if we look back for the last sort of 3 years, then that's exactly what we see. We can see that the portfolio did well when markets were rising, when we had that blip around sort of September, October 2016. The diversified portfolio provided fantastic protection. And then since then, we've seen some good growth again, and the portfolios have continued to rise nicely. So that is the benefit of a diversified portfolio. And it's not about trying to time the market. It's about time in the market with the right strategy. And that's exactly what we've seen from Portfolio Metrics and the diversified approach. So the market ahead, well, that's a tricky one. We're almost certainly, well, I suppose the first thing I would say is that anybody tells you that they know what's going to happen with the stock market, I run in the opposite direction. There's a saying that goes that market forecasters are there to make fortune tellers look good, and really trying to second guess what's going to happen with the stock market is pretty much impossible. I think one thing that we could say fairly safely is that we're definitely in the latter stages of the stock market cycle. We've had some very strong growth really for around about 10 years now nearly, and whilst there's still potential for more growth, we're definitely going to be getting closer towards the end of that cycle. Now, there's less scary things happening than we had last year. There's less scary elections other than Italy, the Italian election. There's less big events on the horizon. There are, of course, still the risks of things like North Korea and the tension between the US and China, and of course Brexit. We can't go far without Brexit. But then there's equally some very attractive long-term opportunities like the Japanese equities, and so there really is. I think there's still potential for good growth, but if you've had astonishingly good growth and maybe if you're in the later stages of your life, or you're in retirement, you might start to think, well, do you know what? I don't need to take as much risk as I'm taking now. I know there's probably still some more growth out there, but actually it might be worth downscaling the risk. If you're further from retirement, you may say, well, actually, it doesn't matter so much if we have a crash and then a recovery, because that's going to happen at some point. The question is just when. But if you're at the point of which you've now got all the money that you need for the rest of your life, potentially it might be worth thinking about taking some risk off the table, because at some point we're going to see a correction. So let's have a look at the performance of the portfolio metrics portfolios, and the way that we've kind of been doing a number of different aspects of all of the different aspects of what I'm about to go through with you in terms of the review. But I think we decided to try and make it a little bit more clear in terms of the different areas of the performance analysis that we want to cover each and every year, and we've called that the 5-carat performance analysis. And the first step to that is let's look at how portfolio metrics are doing compared to everybody else, all of their competitors. Because ultimately, if you're getting 10% growth, that may feel fantastic, but if everybody else is getting 15, it's not very good, and if everybody else is getting 5, it's sensational. So let's have a look at how portfolio metrics are doing compared to the discretionary managers. Now, they're typically the people that we would go to if we're investing £2 million or more. So they seem to be the best of the best, certainly the most expensive from a fee point of view. The way that we compare against those is against the ARC index. So ARC are an independent consultancy company that take the data from literally thousands and thousands of different portfolios for each company, put them into 4 categories of risk, and then give us the average return of that world. Then also we want to compare against the fund managers. So whilst the discretionary managers are people like Coutts, UBS, Investec, all of those sorts of guys, the fund managers are more like the Jupiter, Fidelity, but we want to compare against the diversified portfolios in the fund-based world as well. Most of you will probably be familiar with this charting, but we will. I'll remind you about it just to make sure. So this is the amount of risk taken compared to the annual growth. So up and left is good. If we could have 16% a year growth with 0 risk, that would be great. Sadly, that's not possible. But what we do want to focus on is up and left. So we've got 3 lines on this chart, as you can see. The purple line is the ARC, so that's the discretionary managers put into all the portfolios put into those 4 categories of risk. So you can see if you took let's say this, you were getting for 6% risk, 6% volatility, then you were getting about 8% a year growth from the discretionary managers. From the fund-based world, for that same 6% of risk, you were getting a bit less than that. You were getting probably around about 7.4, 7.5% growth a year. For portfolio metrics at that line, well, this dot here is 63 out of 100 on the risk scale, so you can compare that to where you are. Just to bear in mind, so this whole lot blue line is the portfolio metrics line. So that's 100 out of 100 on the risk scale. That's 1 out of 100. As I said, that's 63. So if we take that dot there, then we can see that we've had somewhere in the order of 11.6%, 11.7% growth per annum for that same level of risk. So if we look at the last 3 years, portfolio metrics performance compared to all the discretionary managers out there and all the fund managers out there has been really, really good. But we also want to look at some different time frames. So let's look at the last year. Well, that difference, it looks even better. Again, let's take that same dot here at 63. We can see that's been delivering somewhere in the order of 13.4% per, over that 1 year, whereas the average fund manager was delivering around 9 and a bit, and probably the average discretionary manager around 9 for that same level of risk. What you'll also notice is that volatility has been very low. Now that's an interesting point, and the best example I can give you is that the volatility has been so low in the US that we had positive growth every month in the US market. Now the last time we had that, I think, was 1958. Oh, I'm sorry, I'm just reading a question from Amber. Okay, good question. Thank you, Amber. So Amber's question is, how does our risk score relate to the scale on this chart? The honest answer is it doesn't. You will see that on chart 1, the volatility, I will show you how volatility relates to your risk scores later on, actually, Amber. So I'll come back to that when we look at a different form of performance reporting later on. It'll be easier to show you. Obviously, the higher the volatility, the higher the level of risk, and therefore the higher the risk you would hope that the higher the risk score you've set the manager, the higher the level of risk you've actually got. But this is based on the actual risk you got, not what we told them to take. But what's interesting is the US market, as I say, has grown positively every month for 2017. The last time that happened was 1958. So it really has been a very low volatility year. And you can see that by this chart. We can see that we've got, for that 63 out of 100, we've got less than 4% volatility, whereas historically we've got more like 6% volatility for that level of risk. The important thing here, though, is the fact that the performance for portfolio metrics compared to all the discretionary managers out there and all the fund managers out there has been really good over the last year, last 3 years, and since inception, which is basically 5 years. So we're really happy with what portfolio metrics are doing and wouldn't recommend any changes at this stage to them as a discretionary manager. But what we also do, so we do that reporting every quarter to look at how they're doing compared to those different benchmarks. What we also do is we take about 30 different companies and we compare the portfolio performance against them, just to see if we can find somebody that's consistently doing it better. Now, I haven't picked all 30 here, I've just picked a few to show you. And I haven't just cherry picked the best ones, these are exactly the same companies I showed you on the client review workshop last year. So this is 7IM, Justin Urquhart Stewart, the guy with the red braces off the BBC. Now, I'm not going to spend the time talking about each of these in depth, but just remember that the blue line is portfolio metrics and up and left is good. So clearly you can see much better performance here from portfolio metrics. This is Barclays. Interestingly, Barclays had a really good year, but their longer term performance has been absolutely shocking. BlackRock, low risk, did well over the last year, but poorly 3 and 5 years. This is Close Brothers. This is Jupiter. This is, the Jupiter Merlin range of funds that this is comparing against are renowned in the industry for being market leading diversified investment funds, and yet the performance is nowhere close to portfolio metrics. This is Newton, Old Mutual, Schroders. Something weird going on with their risk management here. As I said earlier, we want to see a nice arc that shows that the more risk you're asking them to take, the more risk they're delivering and the better returns they're getting. Here, some people that asked to take more risk got less risk than people that asked to take less. This is St James's Place. Some strange risk management going on there. And Standard Life. Standard Life look fairly good since inception, but over the last 3 years and 1 year, really the performance has not been anything like as good as Portfolio Metrics. So I think from that we conclude that we're really happy with what Portfolio Metrics are doing, and we wouldn't be making any changes to them as a discretionary manager. The second piece of your report or your pack, your review pack, in the review section is about the asset allocation. And what we really want to look at here is the target asset allocation that we've set Portfolio Metrics compared to your current one. What you should see is they should look pretty much identical. They won't be identical because even if the portfolio is rebalanced, last week, each of these different asset classes will have grown at a different rate, and therefore they'll be just slightly different. But interestingly, when we did the first client review workshops this year, clients saw a much bigger slice of cash than they should have had. So in their current one, they had a much bigger slice of cash than they should have had in their target. That was because we were right the way in the middle of a rebalance, and so there was money that had come out of some funds but was on its way to other funds. So sometimes you'll get that rebalance has now all been done. So I don't think you will see that. But if there's anything wildly different between the target and the current, we should have already picked it up. But if we haven't, let us know, because those should look fairly similar. And that shows that Portfolio Metrics are rebalancing that portfolio for you, and that you're getting the level of risk that you actually asked them to take in the first place. You've then got the list of underlying investments, some familiar names in there as usual. The Jupiter European Fund has been in there since the start, but then some unusual funds like PIMCO are very good at fixed interest. Vanguard track market, so that's a very low cost fund to track a particular market. And then also things like the Polar Fund, for example, you couldn't get access to that without going through a discretionary manager. So that's the list of investments. More interestingly, though, I want to look at the real growth that you've had. And everybody always asks us, how much money have I put in and how much is it worth? So what we do is we give you the above or below the line chart, which is the next piece of your review pack. The black line, as a reminder, is money that you've put in. If you're putting monthly contributions in or regular bits of money, then that will carry on going up. Ad hoc lumps of money will obviously increase like that. And if you're drawing money out, then that black line will actually drop, because that's money in minus money out. And obviously the block values behind it are the values of the portfolio. So you can always see if you're above the line, your portfolio is worth more than you've put in, and if you're below the line, it's worth less than you've put in minus what you've had back. Now your chart will look slightly different to this, because your chart will have one colour for your pension if you've got one with us, one colour for your ISA, one colour for PIP, and obviously if it's a couple, there'll be multiple versions of those. In this chart, it's just slightly different in that we've just got, they're all a PIP, but actually these are actually different levels of risk, so that's why it looks slightly different to yours. You then go on to the underlying account performance. So these, if all your portfolios were started, all your accounts were started on the same day at the same level of risk, these should all look pretty much the same. If any were started at a later stage or were started at a different level of risk, this will demonstrate how the performance has changed. Because of course, if you happen to start an investment at a very good time when the markets are low, that will benefit from better performance. And equally, if you start them at an unlucky time when the markets are a bit higher, then that will suffer from poorer performance. Also, if you've got a lower risk portfolio, you'll see how that performance varies compared to the higher risk portfolio. But more important and more to focus on and more useful is this consolidated performance, bringing all those accounts together and saying, well, this is the day we started, this is the performance we've had. And also, when we set the portfolio up in the first place for you, we would have told you what the expected growth rate was, and that would have been a figure plus inflation. So we've modeled that line for you as well. This growth over above inflation is a really important point, because if we've told you you've had 10% growth, that may feel brilliant, but if inflation had been 11%, you've actually lost money. Equally, if you've had 3% growth, you may think that sounds a bit rubbish, but if inflation was negative at -1%, then actually you've had 4% real growth, and that's actually good. So this growth over and above inflation is really important. So you can see in this example, we've got 3% growth plus inflation. Now, inflation we assume to be 2.25% at the moment. So this is assuming 5.25% growth after fees. And then what we've actually had is much better than that. Now, this is all genuine data, by the way, that I'm showing you here, and it relates back to January 2013, which is when the Portfolio Metrics portfolios came into existence, or in their current format. So as a result, if your portfolio has been investing for less than 3 years, the data that you're looking at is arguably not that meaningful, because you really need at least 3 years of investment data for it to be meaningful data. So much better to look at the numbers that I'm showing you here, because at least then you're looking at live, meaningful data, albeit at a different level of risk to your own one, but you can translate that back to your own. So you've got the growth compared to what we expected there. As you can see, there's been some fantastic growth, much better than we expected, and you can see the figures here. So we expected 24.5% growth in total, and we've actually had 43.5% growth in that 5 years. So that's really brilliant, and I think all of you will see that the performance has been very good on your portfolios. And my expectation management will be telling me to say, don't expect it to continue this good all of the time. The growth has been very good over the last few years, and whilst there's still plenty more growth out there, I'm sure, don't expect it to be at this level continually, because it's unlikely to continue. Now, one of the other things that we always want to look at is the active versus the passive performance. So what do I mean by that? Well, by active funds, that's where Portfolio Metrics are going out and picking a fund manager that's trying to beat the market, and you're paying slightly higher fees to get that fund manager to try and beat, for example, the UK FTSE 100. The passive alternative would be where you just go into a passive tracker, like the FTSE 100 index tracker. You pay lower fees, but all you do is benefit from the tracking of the market. You'll never get any better performance than the market. Now, Portfolio Metrics have they don't mind which route you take. They do deliver portfolios on both and the several blends of the two. But what we've recommended for our clients in the past is that we've put you on the no tilt approach. So that means that typically around about 80% of that portfolio is active funds, and about 20% of that portfolio is passive funds. Fund areas in things like Japan and the US, where they've struggled to find managers that can consistently beat the market, they'll tend to have some passive holdings. That's where you see Vanguard in the portfolio. Now, this chart, again, same concept of risk versus annual return as we saw earlier, but what this is looking at is what was the return for the fully passive approach compared to the core approach. Now, pretty much all of our clients are on the core approach, unless you've got a strong preference to change it to passive yourself. Now, importantly, this chart is after fees. So the cost difference of these two charts has already been eliminated here. What we're seeing is on the core approach, basically what we've been seeing for the last 5 years, because we look at this chart every quarter as well, and that is, again, we take this 63 out of 100 as our example, about 2% extra growth per annum has been delivered as a result of the active funds over the passive funds. Not only that, these two dots here would have identical asset allocations. So in theory, should deliver the same amount of risk, but not only has the active managers added extra amount of growth, they've also decreased the amount of risk that you've got. So if ever anybody asks you or tells you you can reduce risk and increase returns, that's usually a good thing to do. Now, we don't mind, again, whether you have a more passive or more active approach, but we've seen this trend every quarter since Portfolio Metrics have been managing our clients' money, And actually, we used to report on this same type of analysis every year when we managed the portfolios ourselves for the 8 years prior to that, and we saw exactly the same trend. If it's a properly diversified portfolio, it typically delivers around about 2% extra growth after fees. Maybe just under 2% would be the long-term average, but 2% extra growth after the additional fees is definitely worth taking. So we don't think that you should change that. Interestingly, I've just read, I mean, I know the Sunday papers will always say invest in passive. I've just read another book that's telling me exactly the same thing. And that's great. And I think if you were going to go off and do this on your own, the passive approach would be the safest approach. But if you can find a way of consistently getting that better growth after, over above the passive and after fees, then it's definitely worth taking. And as you can see, you're benefiting from it at the moment. So this is the chart, Amber, that I said would be the easiest way to look at the amount of risk and the volatility compared to your risk level. So these are the 7 dots that you saw on those earlier charts. And we keep an eye on all of those 7 portfolios because we know that every client's somewhere between 1 and 100. So you can see that the amount of risk, the volatility that 1 out of 100 got was 1.83, whereas 100 out of 100 got 9.58. So you can see it graduates up as it should do, which is excellent, because that we saw earlier that some of the fund managers can't control their risk properly, whereas Portfolio Metrics are delivering exactly what they promise, which is the more risk you ask them to take, the more risk you actually get, but also the better the returns you get. So you can look at and compare these returns compared to your own specific risk level. So again, that's 63, which I tend to just focus on because that's probably got the greatest collection of clients around it. Has got a long-term volatility of 7% or nearly, and it's had a total cumulative return of 52.48% in that 5 years, which is an annualized return of 9.52%, which I'm sure you'll agree is pretty fantastic growth, and why I'm trying to manage your expectations and to not get used to it. But it is important that we review your risk level every year. We asked you all to complete a new behavioural finance questionnaire before this review. Some did, some didn't, as always. If you did and we saw any wild changes, then in your recommendation we'll have suggested that we review that risk level and maybe tweak the risk up or down depending on what your scores were. But I wanted to show you what a portfolio looks like and how it changes with different risk levels. So you can see here a 20 out of 100 portfolio has nearly half of the portfolio is in cash and stable assets. A good third of the portfolio is in bonds, so low to medium risk in investments, that's loans to governments, loans to companies, more secure than stock, and then with the rest, just a bit under a quarter is stocks and shares. And that's going to deliver you something like 2.34% growth plus inflation. Now, it might be just one thing worth pointing out here. There is your own fee model will take into account, will change what this score looks like. So just use these as relative to the next one rather than your own one, because they will be slightly different, because this doesn't allow for things like the wealth time fees and your ongoing fee for our review service. So 2.34% at 20 out of 100 goes up to 3.14% growth at 40 out of 100. And you can now see the cash and stable assets is just a bit under a quarter of the portfolio, still about a third in bonds and fixed interest, and now about just a bit over a third is in equities of one form or another. 3.14 becomes 3.86 at 60 out of 100, and you can see now that the cash and stable assets has nearly gone completely. Started to see some global property coming into the portfolio. Equities are now over half of the portfolio, and we've still got maybe a little bit under a third in bonds of one form or another. 3.86% growth then becomes 4.5% growth at 80 out of 100. Cash and stable assets have gone. We've got less than a quarter of the portfolio in bonds now, and the remainder is all in equities with a bigger slice of global property. Interestingly, People think of property as a low risk asset, but that's not how Portfolio Metrics see it as an investment opportunity. It's just worth pointing that out because there is more investment risk in property than people think. So let's look at some changes and some opportunities that are out there. Oh, I've got a question before I go into that. Thank you, Matt. Great question. So Matt's question is, how does the management of the fund react to potential downturns in markets even when you have a relatively high risk score? The best way I can show you that is, the higher the risk score, the more bumpy a ride that you're going to get. The faster the roller coaster is going, but the scarier it's going to be. So you can see, if we took the two extremes, 1 out of 100 has been a bumpy version of cash. You know, when we saw this market fall here, really a 1 out of 100 portfolio, it did see a bit of a drop, but it's only really noticeable because you've got a flat line going through it. Whereas the 100 out of 100 portfolio fell from there to there pretty quickly. So you're definitely going to see faster falls in a market crash in a higher risk portfolio than you will on a lower risk portfolio. But in a market rise, you'll see much faster growth. And in the long term, even taking into account these falls, you're likely to see better returns from a higher risk portfolio than a lower risk portfolio. Of course, that's not guaranteed, but that's the likely outcome of taking more risk. You get better returns, but a more scary ride. I hope that answers your question, Matt. Thank you for that. So, changing opportunities. Now, one of the things that we've occasionally got asked for, not very often if I'm honest, is an ethical version of the portfolio. And Portfolio Metrics have now launched ethical versions of all of their portfolios. Now, the difference between having an ethical portfolio than a traditional portfolio is it's screening out certain companies and certain investments that are considered less ethical. Now, that could be arms, it could be, as in guns, it could be tobacco, for example. Those sorts of things are screened out. Now, by screening out a whole load of companies, you're now reducing your investment pool to pick from, which immediately increases risk. So what you tend to find with ethical portfolios is they take a little bit more risk, and therefore, as a result, they get a bit more volatility. And you could argue that might lead to better returns in the long run, because more volatility sometimes does, but also because generally speaking, over time, people will say, well, okay, you know, it's no longer acceptable to invest in tobacco, or tobacco is no longer a good thing. Therefore, tobacco companies do poorer over time, and more, you know, green solutions do better. So you could argue it might increase the returns in line with the volatility, but I think my take on it would be that so basically you can now have ethical portfolios with the same Portfolio Metrics approach as you have, just with that ethical screening. I don't know that I would recommend you all switch your entire portfolio to ethical portfolios, because I think the extra risk you're taking is possibly not worth it, not unless you've got a very strong moral guide to take you there. However, it doesn't have to be an all or nothing decision. So you may say, well, actually, I like the idea of switching one of our ISAs or this PIP into the ethical portfolio and leaving the rest in the core approach. So that is an option that's available to you if you want it. If you do want to do that, or want to just chat about it some more, put that on your feedback form at the end, and we can have a look at that for you. But it's there if you would like it. One of the most important things to talk about at the moment is the pension allowance. Pensions are definitely the most tax efficient tax wrapper that are out there for almost all people. They're very good from an income tax point of view, as I'm sure you're all aware. They're very good now that we've got the increased flexibility when you come to draw the money out to minimize income tax. You've obviously got your tax-free lump sum as well. The growth inside the pension is free of capital gains tax. But also, when you come to towards the end of your life, they're very tax efficient from an inheritance tax point of view too. So they're a really valuable wrapper that we want to maximize as much as possible. The government actually made them even more attractive from a tax point of view, but and a flexibility point of view as well. But at the same time, they've reined in how much everybody can use them. So you really want to be using up as much or all of your allowance each year that you possibly can. Now that allowance is now £40,000, so you can put up to £40,000 into your pension each year. Now, firstly, you need to be earning at least £40,000 for that to be a sensible thing to do, because that's the only way you get the tax break. But also, if you're earning over £110,000, that £40,000 allowance starts to potentially fall, and can fall as low as £10,000 if you're earning £210,000 or more. So you have to be really careful that you don't put too much money into your pension, go over your own allowance, which is, as I say, maybe less than £40,000, because that means you're not going to get the tax relief going in, but you're still going to be taxed on the money when it comes out. And that means you're effectively opting for double taxation, which is not that clever an idea. But using up that allowance, and also using up previous year's allowances, so you can go back for the last 3 years and use up unused allowances that you've got available, is a really sensible idea, because it's maxing out that pension allowance, and it's a use it or lose it allowance. It's a bit like the ISA allowance nowadays, and that's how I see it really. So you really want to max out on that pension as much as possible, because of the income tax, the capital gains tax, and in the long run, the inheritance tax benefits that that's going to give you. If you need help with calculating how much you can put into that pension, then obviously you can let us know, and we'll do the calculations for you. And of course, it goes without saying that the ISA allowances are also really important. You really want to be maxing out on those ISA allowances. Different tax treatment to the pension. Yes, you pay the tax today, but you don't pay the tax when you come to draw it out in retirement. The benefit of having both the pension and the ISA allowances when you get there in later life is that you can draw out a certain amount of money from the pension, use up all your tax allowances, then take the extra bit over and above it from ISAs, which means that you'll end up paying no 40% tax, depending on your level of income, no 20% tax either, but still getting a good income. So you really want to use those ISA allowances. The ISA allowance is £20,000 each. Where we've got money in a PIP, which is an unwrapped investment, what we'll have done is we'll have written to you probably at the end of the start of last tax year, so May last year, to say, do you want to fund your ISA allowance from your PIP? If you haven't done that, and it's on your review pack to say that we haven't fully funded that ISA allowance, please let us know if you'd like to fully fund that, either from cash or from the PIP. And then next tax year, so probably usually we don't get to it in April because we're still dealing with all of the stuff that was happening prior to the tax year, but usually around the start of May, we'll be getting back in contact for those people that do have a PIP to ask you if you want us to move that money across to use up next year's ISA allowance as well. And that's a really good thing to do, so that more and more of your money over time is growing tax-free. One other great thing that we can do is to try and maximize your capital gains tax allowance, because most people don't use their capital gains tax allowance up each year. So if you've got a PIP, then that is growing, or it can be called a general investment account on things like Transact or Premium, then that is growing and it's subject to capital gains tax, unlike the ISA. So we obviously want to take money out of that and put it into the ISA each year to minimize the amount of capital gains tax in the long term. But what tends to happen is that more and more, so as the year goes on, any investment switches that Portfolio Metrics make will trigger a capital gain. So it might be that you get to the end of the tax year and you've used up, say, £4,000 or £5,000 of your tax allowance. But that means that potentially, because the allowance is £11,500, we've potentially got another, let's say, £5,000, £6,000 that's going unused. Now, if you've got a very big portfolio, a very big PIP investment, then we might have already used up that allowance. But if not, then we may have another £6,000 of capital gains tax allowance available. So what we can do is we can switch from, let's say, the UK equity active fund that we've got in the portfolio to the passive equivalent, and we do that for 30 days, and then we can switch back. That is enough to trigger the gain, and that means that we can use up that capital gains tax allowance. The benefit of that to you is that if 10 years from now you decide you want to encash the whole thing, there'll be little or no capital gains tax to pay because you'll have been locking down those gains each year. Whereas, had you not done that, you'll have capital gains tax to pay on all of the gain over and above the allowance in that year. So it's really valuable to do that. So we'll be writing to you fairly shortly to find out if you've got any capital gains that we don't know about, and also to ask you if you'd like to do the CGT harvesting, assuming it's appropriate to you. If you don't have a PIP, it's not appropriate. And if you have a PIP that's of sufficient size that you've already used up your CGT allowance, then we can't do it as well. But for those that it's appropriate to, we will write to you. One thing that's just a useful thing to explain in case anybody wants us to help them with it is when we used to set up company pension schemes years ago, we used to offer the employer something called the Future Pension Promise. It's very easy for people to say that, oh, I can't afford to save any more into my pension at the moment, but when I get my pay rise, I would definitely be able to afford it. Then, of course, the pay rise comes around, they get used to spending that higher amount of money, and guess what? The next time they see their financial advisor, they can't afford to put any more money into their pension. So the Future Pension Promise was born out of that ability to commit to saving in the future with money that you haven't seen yet. And so one thing that, if you're making monthly contributions, one thing that we can offer and help facilitate for you is to set increases in the future. So if you tell us when your pay rise is and how much of that pay rise you want us to allocate to your monthly savings, and it doesn't have to be your pension, it could just as easily be your ISA or your PIP, then we can organise those increases and say that, right, in April you get this pay rise. If it's an extra £1,000 a month, we're going to take an extra £300 a month off you. So you still get a nice £700 a month pay rise, but an extra £300 a month is going into your investment account. And that's helping you get to that ideal target much more easily and much more painlessly. So if that's something that you'd like our help with, please do let us know again in the pack. One other thing that might be of interest, I try and pick this off where it's obvious and relevant to my clients, but sometimes it gets missed, so it's just worth covering. Now, if you run your own company, you may still want personal life insurance. With a bigger company, you might get death in service. But if you run your own company, it is possible to do a policy that's similar to death in service, that's just on one person's life, on a single life basis. The benefit of doing this is that it's a corporation tax deduction, but it's not a benefit in kind. So it saves roughly 30% of the cost of the life insurance through tax breaks. So if you or someone you know has their own limited company and also wants to have life insurance to protect their family, because obviously that's a sensible thing, then we can do that as what's called relevant life cover, and it will save them about 30% of the cost. Now, if we haven't done that for you, or you know somebody that would be relevant to, then we're very happy to do some quotes to say this is how you can save, because nobody likes paying money for life insurance, but it's a necessary evil for many people, and this is a way of bringing that cost down through tax savings. And while we're on the subject of death and illness, it's worth just staying with that, because historically critical illness policies used to cover around about 30 illnesses. And then about 5 or 6 years ago, a company came into the market called Vitality, and they did a comprehensive policy that covered 161 illnesses, obviously a vast difference. And what's just happened in the last year is, by the way, you paid more for the 161 illnesses than you paid for the sort of core 30, but and at 161, it doesn't always pay out the full sum assured, so it pays out the full, sum assured on the first 30 to 40 serious illnesses, but then the next tranche of illnesses, it pays out 75%, next tranche 50%, etc., etc. But what's happened with the market is starting to catch up, and what they've introduced now is a lot of the mainstream providers are now covering as many as even 50 or 60 illnesses. So if you've got any critical illness cover that is sort of you've had running for a few years, we did write to quite a few clients about this, but sometimes you have policies that we don't know about, or sometimes it's somebody you know. But if you've got a critical illness policy then we're more than happy to review it to say, look, actually, you could, for the same money, you could now get 50 or 60 illnesses covered as opposed to the 30 that you've got. Or you may even want to go up to 161. If you've already got the 161 illnesses covered, what we're finding is the mainstream providers, these 50 or 60 illnesses, are actually often cheaper than that comprehensive cover. So either way, there are some opportunities there that we can look out for you if you like. And one other change I just want to make sure that you're all aware of is with regards to property. I'm sure you probably know this, you've probably read it in the papers and seen it on the news. But the government doesn't terribly like buy-to-let landlords, and they're making it even less favourable for them. So what they've done is they've obviously increased stamp duty for second homes by 3%. They have also, and more importantly, phased in a change that happens between now and 2021, which is where you're no longer going to be able to offset your mortgage interest against the rent. Now this chart shows you an extreme example of somebody with a £400,000 a year rental income. So it's a pretty big investment property portfolio. But interestingly, this example was going from zero tax every year to £80,000 in income tax a year. So that's a neutral portfolio going down to a loss-making portfolio by £80,000 a year in 2021. Now, the reason I tell you this is, firstly, if you own a buy-to-let property and you're thinking about getting out of that property at some point, personally, I would do it sooner rather than later, because I honestly believe that we're already starting to see some of these properties come on the market where people are getting a tax bill that they didn't get before. And if they were making £200 a month on a property before, then potentially by the end of this they'll be making more like a £200 a month loss. And I think by that point people aren't very keen to pay a monthly premium for the privilege of owning these properties in the hope that they might go up in the future. So if you are thinking about selling at any point, I would probably get on and do it sooner rather than later. And I think that is also because if we see many interest rate rises between now and then that's only going to compound this further. Somebody that's got £800 a month mortgage costs but £1,000 rent currently makes £200 a month profit. If we roll that forward and say, well, maybe in a few years to 5 years time, the mortgage cost is now £1,000 a month. So they've now got no profit on the rent, but they've actually got a £400 a month tax bill for the privilege if they're a higher rate taxpayer. So they're now paying £400 a month for the privilege of owning that property. Unlikely they're going to want to keep it. So I would just be very careful around the buy-to-let side of the industry, because there's going to be some nasty shocks there, I think. Now, quite often, as part of a financial plan, we'll recommend some estate planning for clients, and sometimes it doesn't get done at the same time as the financial planning, because quite often the financial planning is the place where the primary concern is, and so the estate planning sometimes gets put to one side. And so I wanted to revisit it for two reasons. One is because it's a good idea to there's quite a lot of clients where we're recommending that we do the estate planning in one form or another. But there's also a number of clients that have, in fact, there's a number that are on this webinar now that have done this type of planning already. So it's quite useful to go back over exactly what the planning looks like and why we do it, because quite often at review meetings we get some questions around, just remind me why we put this trust framework in place. So let's have a look at an example, and I'll use Carol and I as an example because it's easier talking about something nasty happening to yourself. So if we just had a will, then what you'd probably expect us to do is, if something happened to me, then I'd leave everything to Carol, my wife, and then on her death, we'd want to leave it to Fiona and Bronwyn, our daughters. Seems like a sensible plan. The problem is that actually it may not all get to the people that we want it to get to. So firstly, after my death, if Carol was to go off and remarry, so let's say she meets Juan and was to remarry with Juan, then if her and Juan get divorced, then potentially half of my children's inheritance is just disappearing off to Juan. Equally, worse still, if Carol was to marry Juan and then die, actually potentially all of my daughter's inheritance could end up in his hands. Even if Juan never enters the frame, then if Carol ends up in a care home, then basically our entire estate has got to be spent before she gets any help from the local authority to pay for care fees, which would therefore mean pretty much no inheritance for Fiona Bronwyn. And as and when Carol was to pass away, everything is in her estate for inheritance tax purposes. So again, not an ideal situation. But that isn't where the problems could end, because as and when Fiona Bronwyn inherit that money, if one of them meets the son-in-law from hell, for example, then actually potentially we could be losing half of their inheritance to him. And of course, as and when Fiona Bronwyn want to leave it to their children, they've got the whole inheritance tax problem all over again. So let's have a look at how a trust framework can help. So on my death, I can start to leave some assets to trust. Maybe a share of the property, maybe just some of the investments. The rest would go direct to Carol. The money or part of the house that goes to Carol as part of the goes to the trust can still go back to Carol as an interest-free loan, so that if that's a share of the house, she can still downsize, sell up, do whatever she wants to do with the house. If it's investment, she can still draw an income or spend it. It doesn't stop her spending that money. What it does mean, though, is if Carol was to marry Juan, that on her death or divorce, at least we started to ring fence some of the assets to make sure that Fiona and Bronwyn do at least get some of what we wanted them to get. As and when Carol, if she was to go into a care home, then that can start to protect the assets from that. But more importantly, as and when Carol was to die, not all of the assets are in her estate for inheritance tax purposes. As and when Fiona and Bronwyn want to draw the money out of the trust because Carol and I have now turned up our toes, then they can also draw the money out as an interest-free loan, which means that if they were to get divorced from the son-in-law from hell, then at least this is protecting some or all of their assets. And as and when they want to leave it to their children, they can return the loan to the trust and send it down to the grandchildren, meaning that it's potentially free of inheritance tax. So this planning has the opportunity to save some inheritance tax between Carol and I and Fiona and Bronwyn. Not all of it by any means, but it can be some, particularly if Carol was to outlive me by a good number of years. Whereas the opportunity to save inheritance tax between me and my grandchildren is huge, because it doesn't save a huge amount here, but it eliminates potentially the inheritance tax on all of my estate between Fiona Bronwyn and their children. So when you hear about the trust framework, it's important to think about how this relates to your own situation, but also consider it from the generation above you's point of view. Because if, let's say, if your parents are still alive, then if they leave their inheritance to you through this trust framework, then when you come to pass their inheritance down to your children, potentially you've eliminated that inheritance tax problem. If they just leave you those assets through a will, then that's only going to compound your own inheritance tax planning problem further. So it really does, a trust framework really does have the potential to save your generations quite a lot of tax, but also make sure that what you want to happen to your money does in the most protected way possible. Now, of course, which trusts go into that framework will differ for different people, and that's why we've detailed those specifically on your recommendations page. And one interesting thing is that we've got this residential nil rate ban that's been introduced, which is where the Tories said that we get the amount of money that can pass down free of inheritance tax. We could get that up to $1 million. It's linked to having a property. There's a whole load of hurdles to jump over it. It's my belief that the revenue will realise it's an absolute nightmare to police, and they'll end up just making £1 million allowance. But at the top, for the time being, this is what we've got. One of the things that we need to be careful of with trust planning is that we don't mess up the residential nil rate ban, but also one of the types of trusts that we put in the trust framework actually helps ensure that you benefit from the residential nil rate band. So this is really careful planning. If you've ever done a will with an old will trust in there, where a trust was created on the day that somebody died, then that potentially can cost you the residential nil rate band and increase the amount of inheritance tax your children pay. So it's really worth, if you've got those, that they're reviewed. But what we've done in your review pack is we'll have spotted opportunities where we can put the right type of trust planning in place for you to maximise your planning opportunity. And one of the other benefits of completing the pre-review questionnaire is that you can ask questions and where I see a question that I think would be interesting to more than one client, I will address it in this manner. And one interesting question came out from a client of ours that's been a client of ours for a few years, and he just asked a question about the future safety and security of Efficient Portfolio as a company. What happens if something was to happen to Efficient Portfolio? It's a great question. It's something that we quite often, or we actually used to get asked when we were a bit smaller company, I suppose, from new clients, but it's not something that we ever really cover with existing clients. So I thought it was a good opportunity just to kind of update you as to where we're at and tell you, where we're going as a company. So Efficient Portfolio has grown significantly. We're now we're double the number of people that we had at this time last year, and so security-wise, it's much better than it's ever been. Now, if something happened to me, we've got a number of other advisors in the business that would be able to take over looking after the clients that I look after directly. So actually, if something did happen to me, it's my belief now that both the combination of the advisors and the management team that we've put in place would continue to run Efficient Portfolio. Now, of course, at some point, there would need to be an ownership decision going on, and my hope is that business would be bought from Carol, because she, I don't think, would want to run it, by my team. And there's actually money that would drop into Efficient Portfolio, a substantial amount of money that would drop into Efficient Portfolio if I was to die, that would hopefully allow them to facilitate that purchase. Now, if they decided they didn't want to buy Efficient Portfolio, there's also a contingency document in place that would make sure that, or basically I've detailed the ideal companies that would potentially A, be really interested in buying Efficient Portfolio, and B, be the best match for our clients. So from a structure point of view, I think that we're as strong as we've ever been, and we're as safe a pair of hands as we've ever been. In terms of our future, we're not wanting to grow aggressively. We are growing very quickly, but it's organic growth. We're not looking to go off and buy other financial planning practices, particularly if the right one came up on our doorstep, we might look at it. But we're not looking to go off and expand really aggressively, because we want it to be nice organic growth to allow us to continue to deliver a better and better service to our clients. Now, you should all have access to the investor portal by now. You also should have access to the portfolio metrics portal. That's the one that gives you the performance reporting, but it's the investor portal that for me is the most important one to make sure that you've got access to, because over the year ahead, we're going to start to use the secure messaging much more, and because that just protects your data as a client of ours. It means that there's so many more cases of people's emails being hacked that actually this portal, it provides us with a much more way of sending secure and important information to you. And of course, you can keep all of your important documents there as well, and we'll upload our ones that we create for you there. So it's a really important portal to have. I think it's just worth reminding about our disinvestment process at this point as well. So if you ever email us in and ask for a disinvestment, then we will always want to speak to you or something in physical post. We always want at least 2 forms of communication, because as I say, email is just not as secure as it used to be, and as a result, we can't take email communication as being, we're not 100% sure that you sent it. So we will always verify that. So if it ever appears a bit slow and sluggish because we want to phone you up and ask you some security questions, and when you just want to get some money out of your portfolio, I apologise in advance, but ultimately it's there to protect your assets and wealth, and I'm sure you'll understand how important that is. Bit of an announcement for those of you who don't know, the Efficient Portfolio will be moving office in probably mid-May of 2018. Carol and I have bought the White Lion Hotel in Oakham. Here it is, and it's currently in the process of being completely gutted. And as a result, once we're actually now kind of trying to put it back together, it will be our lovely new office in the centre of Oakham. So it's just on the high street past the Esso garage, as you can see, for those of you who know that Oakham. And it really will be a lovely office. We'll have even better meeting rooms than we've got in our Rutland office at the moment. So look out for that move. One thing to just let you know about, and I appreciate some of the people on this webinar are London clients, so it won't be quite so beneficial to them. But if you are in Oakham, whether that be regularly because you're up in this part of the world, or whether you're just popping up to visit our beautiful county, then one of the things we're going to do is we're going to give you some membership cards. And feel free to use this office as a free coffee shop. If you want to pop in for a coffee, and by all means bring a friend as well, then you can. We're going to have a really lovely reception area. You can sit down, enjoy a nice coffee. You can use the Wi-Fi. Maybe you can read the copy of the week or our newsletter, and just enjoy it. Yeah, it's a really lovely office, and we'd be really keen for you guys to pop in. So if you're coming into Oakham on market day, then by all means bring a friend and sit down and have a coffee with in our reception. So we look forward to telling you more about that soon. There will be a launch event on the 7th of June in the evening. You should be getting an invite to that fairly soon, but stick that in the diary and come and join us for some really lovely drinks and some amazing food that we're going to put on. The canapes are all going to be done by Fish Tank, which is a new sushi and sashimi restaurant that's opened in Oakham. It is amazing. Don't worry, there'll be some non-sushi stuff as well for those that are the more traditional clients that aren't so keen on that sort of crazy food. But it should be a really nice evening, and I hope to see you all there. We'll also this year be inviting you to an event called the Wealth Workshop. This is a one-day workshop that we invite both non-clients to, but also we're going to start inviting clients because we think it's a good way of you learning more about the sort of stuff that we're doing for you. Some of the techniques that we're using as part of your financial planning and your portfolio. So look out for that. It's a one-day event. Typically it'll run from 10 o'clock in the morning till about 4:30, 5 o'clock. We'd love to see you there if you'd like to kind of further your knowledge on finance. And one of the other things we will be telling you about, or I want to remind you about here, is the referral dinner. So if you're kind enough to refer us to other clients, then each year we do the referral dinner, and we pick a really lovely venue. We haven't set a date or a venue for this yet, but we will be doing that fairly soon. If you have referred us to a client, thank you very much. It's a massive help to us. It's we take huge pride in looking after referrals, and as a thank you, we'll be inviting those of you that have to a really lovely referral dinner this year. Now, I appreciate referring clients into us isn't always easy. You potentially don't know what their financial situation is, whether they've got it sorted. Even if they've got it sorted, have they got a good financial plan, or is it just somebody that's selling them pensions and ISAs? So one of the ways that we've introduced to help you refer clients to us is the Dream Retirement Dinner. So if you've got somebody you think, well, he might benefit, I don't know, but he's a wealthy guy, he may or may not benefit from finding out more about Efficient Portfolio, then we'd love to invite them to the Dream Retirement Dinner. They can come as a couple. We've done a couple of these already, and the last one we did was at Rushton Hall, which is the photo you can see here. Really lovely evening, lovely food. I get to talk about 3 key aspects of how they can improve their financial future. The sort of things like the difference between financial planning and financial advice, which you guys are all hopefully experiencing firsthand, the right type of investment approach, and also the estate planning, the estate protection stuff that I've just been talking about. So we cover those 3 key areas in a really nice relaxed evening over a lovely meal. And so if you know anybody you think might want to come along to that, then please let us know, because we'd be delighted to invite them. We've got these happening pretty much every couple of months throughout the 2018, so there's plenty to pick from. In addition to an invite to a lovely dinner, I just wanted to remind you, and some of you perhaps don't even know this, tell you what the benefits that your referral gets as a result of being referred in by you. So you get a lovely dinner with us to thank you, but they get a free meeting with one of the financial planners here at Efficient Portfolio, which is worth £197. They get a third off their plan fee, which typically will be somewhere in the order of a £400 discount. And of course, they get the benefit of seeing you at our events, whether that be our golf day or whatever it is. We've also got a different event that's going to come up. We're keeping it secret at the moment. We've always been very conscious that the golf day is brilliant. It works really well for us, but it's only any good for people that are wanting to play golf. So we wanted to find something that we could that would tick the box for a few people that weren't interested in golf. So look out for that later on this year. We've got something quite fun up our sleeves, I think. Bear in mind that Efficient Portfolio has its Facebook group. You may want to join that if you want to find out some of the sort of less financial stuff that we're covering, as well as some of the financial stuff that we're talking about. We typically post things like TED Talks and interesting articles that we've read, all sorts of things like that go out of our Facebook group. Some of it is money themed, but some of it's more health and well-being, or how you can really make the most of your time. All the sorts of themes that went into the book, The Dream Retirement. And of course, I'm on Twitter and LinkedIn, so if we're not already connected on those, please do. So we go back to your report, your review pack. You will see that you've got your recommendations and changes that we've put in there. Please can you make sure that you complete those and send those back to us, so that we can then use that to springboard off to improve your financial planning for this year, because obviously the whole point of the Progressive Review Program is to make sure that your financial planning evolves with you rather than gradually stagnating. Those are the areas that we see as being the most important bits for you at the moment. Now, if you didn't send us your pre-review questionnaire, obviously we're working on the information that you've already given us. So one of the benefits to sending that is that we can make sure those recommendations are right up to date for you. But either way, we know all of you pretty well, so hopefully even if you didn't send that form in, those recommendations will be pretty accurate. A couple of people to introduce you to. Katie has been promoted to the Client Relationship Manager. That's because Alex, who has been our Client Relationship Manager, has been promoted to a Paraplanner. He's taken a number of exams that's got him up to Paraplanner level, so that means he's writing client plans now because he's got the technical expertise to do that. Katie's also been taking exams and has been promoted into the Client Relationship Manager role, so look out for communication with her. Now, of course, you can just still use the email address family@Efficient Portfolio, because you guys are our family clients. So if you still use that, that's absolutely fine. It'll just be that at some point that Katie picks up those emails as opposed to Alex. Obviously, if you happen to email Alex by mistake, he won't get cross. He'll just ask Katie to deal with it on his behalf. And I also want to remind you, most of you will know Tim Webb. He has now been an advisor with Efficient Portfolio since the middle of last year. He has been with me for 4 years. He's rattled through all of the exams, and has been really successful since he came to Efficient Portfolio. So we promoted him to financial advisor last year. Now, what we're finding is, as the client base, particularly for my clients, as the client base has expanded, it's difficult to do everybody's one-to-one meetings every year. So whilst I will still want to maintain the relationship and oversee the advice for all of the family clients, what we've asked Tim to do is to do some of the one-to-one meetings. So if you look at the first section, that Efficient Portfolio Summary, there is a bit that says who your one-to-one advisor will be this year. Now, that's because I've gone through and I've looked at the situation and said, well, there's nothing significant happening that we can see for this particular person. So Tim is going to take over some of those one-to-one meetings. For others, it will still be me. But then in future years, maybe if something is not happening, nothing significant is happening for you, it might be that it switches to Tim. And equally, if you've got Tim doing your one-to-one meeting, but there's a big change happening next year, then it might be that I step back in to do that review meeting. But have a look at that, and just if you've got any, by the way, if you've got any problems with that, I think most of you know Tim because he was our client relationship manager for about 2 years. He knows all of your financial planning really well. Prior to any of these one-to-one meetings, I sit down with him and make sure he's absolutely in the clear as to where I think that the advice needs to go. But it's just that time to answer any questions and just tailor and bespoke that financial planning to you. So I hope that's okay. But as I say, if you've got any issues with that, please contact me directly. But it'll just allow us to deliver a better review service. The other part of the last part of the pack is feedback. We always welcome your feedback. It's the only way we get better at doing this stuff. So if you've got any feedback, good or bad, we'd be delighted to hear from you. So please do fill that in. If it's good, we may ask if we can use it in our future literature, or on our website or something like that. If it's bad feedback, we probably won't ask if we can put it on our website, but of course we will try and work out how we can fix it for next time to make the next event even better. So that is the end of the client review workshop. I am going to throw it out to any questions, anything I didn't cover that you think I should have done, or anything that anything in addition to that you've seen that you'd like some help with. Any questions from anybody? You can either type these in, or I can unmute you if you want me to. If you want to raise your hand, I won't unmute everybody because then we can get a whole load of sound pollution, depending on if you're sat on a train platform or something. So either raise your hand or type a question in if you've got any questions. If you don't have any questions, I can only assume I've done a fantastic job of answering them all in advance, and you are now dumbfounded with all of the information I've provided you with. I'm not seeing any hands going up, and I'll wait a little bit while longer because it may take you a few minutes to type this out. But yeah, so it just leaves me to say that thank you guys for logging in. For those of you that are watching this now recorded, because we're going to send this out as a recording to those people that couldn't dial in at this moment in time. Oh, there's a couple of questions coming in. Thank you guys. Oh, hang on, let me just read these. Really good session. Thank you, Amber. That's very kind of you. Many thanks. Really useful. You're welcome, Deborah. Lovely to hear from you. Thank you for the feedback. I can't remember where I was got distracted now, but yeah, it's this is a really great way for us to deliver this message out. If you are watching it recorded, that's what I was going to say, then by all means still email us if you've got any questions. Please do return those recommendations and changes summaries. That's really important, as well as the feedback. And we will pester you for those because it's really important that we know whether you want to go through with those. And then also let us know when you want your one-to-one meeting so that we can book those in at a time that's right for you, given your planning and whatever's going on in your life. But it just leaves me to, I can't see any more questions coming in. It just leaves me to say that if you make the same decisions today as you made yesterday, you'll get the same results tomorrow as you got today. So thank you very much. Have an amazing day, and enjoy the spring once it gets here. It looks like the sun's shining. It feels like we're starting to get into spring, and that is fantastic if you're going to spend some time outdoors. Lovely to hear from you all, and I look forward to seeing you at your client reviews soon. Thank you very much.